Now I'm joined by the Chief Investment Officer, Tom Caddick. Welcome, Tom. Thank you very much for coming in. Now, before the show, we were talking about the four things that are driving the markets. And you said to me that the tariffs, Trump, taxation, and tantrums. Now, tell me more about that and how that is driving investment and behavior.
I mean, I think we could probably throw in a few more T's at some point while we're talking. But I mean, as Madhushree was alluding to just now, there's been a huge amount of activity in the markets, probably at a much more elevated level than most people are used to. And that's been driven largely from the States, largely from what we've seen coming out of the Trump administration. So we shouldn't sort of belittle the impact that has been having on markets, but it's been mostly a relatively short-term impact. So we've seen a significant amount of volatility coming through, and that's driven by a lot of uncertainty, and markets don't like uncertainty. They expect to see growth. That's what they're looking for. Once you start to remove some of that, and particularly uncertainty, that's when you start to get this volatility in markets, which is a very safe way of saying weakness in markets. So that's been the main narrative. Obviously, we've also had a lot of geopolitical activity going on in the background, both from the Middle East primarily, but also out of Ukraine and Russia, which has continued. Now, that's always been the case. I could, any 6 months, every 3 months, we could be talking about geopolitical and some of the things that are going on. It does feel like it's heightened, but in reality, it's probably at a normal cadence, as harsh as that may sound from an investment standpoint. But that has created a degree of uncertainty. So here we are 6 months in to the year, and it feels like we've seen almost a decade's worth of activity going on in the market.
It's interesting that, and I'm just picking up on your last point. I think you're absolutely right. We've seen sort of 10 years worth of stuff in 6 months. What do you make of the pace of change that we've seen and how that drives investment behavior?
So I think there is a theory that what we've seen coming out of the Trump administration was this discombobulating strategy to just keep throwing more and more at the market to put their competitors off, to keep the market on its toes, because we were seeing that almost on a daily basis. When Madhushree was talking about the tariff announcements, that sort of so-called Liberation Day, actually that's very unnerving for people, which is why we saw so much weakness in the market. But the reality of what we've seen is that that's been almost a veneer of activity. What's really sat underneath it has been marginal change, actually, because so much of the deadlines have been extended, so many of the so-called tariffs have been reduced or, again, delayed, and that has created a huge amount of volume in the market. It's created a lot of narrative for anyone looking on, but the reality is the market snapped back very quickly because they started to look through a lot of that noise.
But what is quite difficult at this stage is trying to predict what might happen between, for example, Elon Musk and President Trump. And we've seen that feud get worse and worse in recent weeks. So, we've seen the Tesla stock down. I think it's about a third since its peak in mid-December last year. What does that mean for the wider market? Because it's almost impossible not to be holding Tesla shares in one way or another.
Yeah. I mean, I think there's two things there. I think the fallout was almost the most predictable thing. I mean, you've got two sort of very strong personalities, and we don't need to get into that. It was very obvious that was not going to end well. But clearly what we've seen is this toxicity that's now being attached to Musk and to the companies, the most visible being Tesla. Now, Tesla makes up, is about 1.7%, give or take, of the S&P 500. So it's a very significant, it might not sound huge, but really in the context of a 500 stock index, that is quite significant. And if you are simply owning the market, then you have that level of exposure. And when you get a 20, 30, 40% downturn as a result of one particular stock impacting you, that was going to have a material impact. So very difficult to avoid in the large. That is why we favour active management, so that you can be more selective and be able to reflect some of the risks that are inherent within individual stocks.
Now, there are people, you can point either way. There are people who point to America and say, America is still exceptional. You can point to the jobs report and the rest of it saying there's still strength there. However, there have been a lot of people who are very worried about what's going on in America, and particularly their dollar exposure. I mean, I've got it written down here. You've got global pension funds, insurance companies, they're at 50% or more. But when you look at aggregate countries, it's actually even worse. Taiwan is holding more than 90% of its GDP in dollars. Japan, I think, at 60%. Are we at a point where people are genuinely considering diversifying away from the US dollar?
So I think you can flip that on its head and say, where do you diversify to?
Exactly.
And that's the challenge. We've got positions in gold on portfolios where we can, and that's performed very well, as seen as something of a safe haven asset, along with other tailwinds that have worked for it. Is the euro your fallback?
Well, they'd like it to be, wouldn't they?
Some would.
Yeah.
I think long gone are the days that sterling, so GBP, would have been your safe haven asset. I know that certain people would talk to crypto as a fallback asset class. I would reject that wholeheartedly, not as an asset class, but as a fallback on, volatility in the likes of the dollar. So yes, it could be this level of volatility, this level of borrowing going out of countries can have a fairly major impact on the strength or weakness of their currency, and the attractiveness, they go hand in hand, the attractiveness of their debt in and of itself. So a lot of those holdings that you're talking to there are really, it's about people's countries, nations' investment in treasuries. So I think part of the problem is there isn't much of an alternative. Clearly, as an investor, it does depend on where your starting point is. If your base currency is dollar, that's a very different place to being where your base currency is sterling or euro, and you're now facing a relatively short period of dollar weakness, which has held some of those assets back.
I know a few people have been sending in questions. I think there are some questions on emerging markets, so I'll leave that to you for the Q&A. But I'm just thinking for the moment about being a little bit closer to home and what's going on here in this country. The British Labour government has just had its sort of 1-year anniversary. I don't know whether that's a good thing or a bad thing. What does the investment community make of its sort of first 12 months?
It's interesting, they seem to be celebrating the 1 year much less than they were the actual win in the first place, and I think for good reason. From an investment standpoint, it's very important to separate the local politics, local economy, and market. If we look at the FTSE 100, give or take 80% of its earnings are overseas. It's a very globally diversified market, and it's reflective of that. What you tend to see is when you get shorter term noise locally, it can have an impact on a local market, but that doesn't necessarily bear itself through in the fundamentals. If you're looking for the fundamentals, you'd look at maybe the smaller cap, mid-cap market, so for the smaller companies. Where it is more reflective is in the debt market. So things like the sort of gilts, typically, and that'll be how attractive do those appear to be, or from an investment standpoint, has the risk risen? And I think some of the missteps that we've seen coming out of the Labour government under Reeves as Chancellor have created a degree of volatility in the gilt market, which has been concerning. Nothing like the Truss era. So I think we can breathe a sigh of relief from that perspective. What, again, investors are looking for is predictability and certainty. That's what they're looking for, particularly from government and sovereign debt. That's what they want. It's a safe haven asset, particularly when we're talking about developed markets. So it does shake that, just like we've seen in the treasuries market. So we've seen a degree of unpredictability come in, worries about indebtedness at a national level. But broadly speaking, I think most of the missteps have been at a domestic level rather than necessarily impacting the equity markets themselves.
Although there will be investors who will be watching us today thinking, well, hang on, I do have money here, I've got property here, etc. And I mean, economists are currently predicting about a £20 billion black hole when it comes to the autumn budget. And Rachel Reeves has said she's not going to be changing the borrowing rules, etc. It's very difficult to cut public spending. So, I mean, what are your views on whether or not we're going to see further wealth taxes in the future?
I mean, I think it's clear as a UK taxpayer, I'm concerned. Clearly, I think we were talking before we started about this so-called rabbit in a hat. You know, it's difficult to see where it's going to come from, and the recent wealth tax and the changes to non-dom status looks like it'll have the reverse impact of what was bizarrely predicted. So there is that concern, and I mean, clearly there is a black hole that is being created that will need to be funded somehow. So I'm not an expert on that field, but I would be concerned.
I think everyone's hoping for growth, aren't they? We can grow our way out.
Grow your way out. And that's sometimes where inflation was quite handy as well at times, because if you can inflate your way out of debt and grow your way out of tax deficits, then that would be wonderful, wouldn't it?
It's the double white rabbit, I suppose.
Yeah.
So given all of this, all of these things going on at the moment, where do you see the opportunity? Where personally do you see the opportunities for H2?
So we continue to, I mean, we're cautiously optimistic on equities, and Madhushree was talking to some of the changes. We've probably been more active in this last 6 months than we would naturally be. We tend to sort of, you know, move in and out over time. So we've been more active. But we're cautiously optimistic on equities, probably more favouring Europe. We do quite like the UK market. You know, some of the tailwinds that we're seeing there are conducive, particularly when you look at them against a positive valuation. So the equity, the shares actually just look good value. So to that end, we do like Europe, and we do like the UK in particular. Less so the US. We still have a very significant proportion of our assets and client assets in US, but we have been reducing, as Madhushree was talking to. We do like the bond market. It's always difficult to get people excited about bonds because that's not what they're there for. They're there to give you some, you know, a degree of protection in your portfolio, insurance against some of these missteps. The great thing is that we're starting with really attractive yields. So as we continue to see inflation coming under control, and you see that really very much is the case in Europe, we see that come under control. We see a pathway for rates, base rates, to come down. So the speed of change has slowed, but certainly the directionality hasn't changed. So those are a good environment for fixed income assets. So we do like fixed income. We do like some of our diversifiers as well. You know, it's difficult to get excited about things like gold, which has done so well, but these are really great diversifiers in the portfolio. So I guess the message from us was cautiously optimistic. We do like risk, but we have toned that down a little bit, and we do like bonds. Very difficult to get excited, but we do like bonds.
Thank you, Tom. Thank you. So insightful.
Pleasure.